Hi, I'm Brian House with Frazier Financial. We're here today with Josh Frazier, our Chief Investment Officer. We're going to talk about 4 themes in the markets and the economy that we think will answer a lot of your questions. We're going to talk about the bond market, what that looks like today versus a year ago, and how that might play out in the next 10 years. We're going to talk about experts. They got everything wrong in the last year. We'll talk about how that happened. We'll talk about where we see opportunities today and in the next few months. And we'll talk about what's worrying us for the next 6, 12, 18 months in your portfolios. All right, Josh, tell us why you're excited about bonds.
Most excited in 10 years about bonds. I know you're on the edge of your seat to hear about this.
Yeah, wow.
But bonds are the core of most of our retirement or income-minded investors' portfolios. And for over 10 years, interest rates have been really low. So getting a 0.01% return in your checking account, your savings account, was the norm. But now with interest rates going up so much, our bond investors are now getting 5 to 10% yields on all sorts of bonds. So we are very excited about that part of the portfolio. That's 30 to 40% of a lot of our retired clients' portfolios are in bonds. So this is an amazing time for those investors.
All right, Colin, we're going to put a chart up on the screen about bond yields for the last 10 years. Tell people how they can read this.
Yeah, so the chart shows that the gray bars are different bond categories, and the purple bars are where yields have been historically over the past 10 years. The blue diamonds are where they're at now. So as you see there, every single blue diamond is higher than it's been, which is where we're getting this 5 to 10% yield. It's pretty easy to see there that the yields are higher than they've been, which is very exciting for us right now.
So the safe side of the portfolio is making 5 to 10%.
Yeah, yes.
Big change. So we mentioned earlier, all the experts got it wrong here so far in 2023. We've said before, experts often and frequently get things wrong. Josh, talk about what they got wrong this year.
So the last couple commentaries we've done, one was rated R for recession, where we talked a lot about the recession fears that were out there. Last summer, we did some commentaries. Stock market was down over 20% from all-time highs. And we were buying stocks at that time because we felt like values looked really good in the market. And as we headed into 2023, it was the most forecasted recession in history. Almost every single major expert economist was saying the first half of 2023 was going to be bad in the stock market and bad in the economy. You'll see a couple fun headlines. Dr. Doom is always in the news. I think every day he predicts something bad's going to happen. He was right one time in 2008, so he still gets some sort of airtime, I believe. But the moral of the story is all the experts got this wrong. We don't rely on forecasters because it is such a hard thing to do, and they do not have great track records of actually forecasting the future. Warren Buffett says that forecasters exist to make fortune tellers look good, and they don't even do that probably at this point.
So this year, clients' accounts have gone up pretty significantly. That's been surprising compared to all of these forecasts that we just talked about. It highlights why you have to stay invested. So you want to talk about how surprising performance has been this year?
So you'll see we've got the S&P 500, which is a broad measure of the U.S. stock market, up on a chart for you. We hit all-time highs about a year and a half ago. Not quite back there, but clawing our way back from the lows of 2022. Despite the market having a nice rally off the bottom, a lot of investors have been caught flat-footed in cash on the sidelines. We actually have over $5 trillion with a T dollars of cash in the U.S. sitting on the sidelines that missed out on this rally because they were nervous about what was going on in the economy. Our clients were participating in the market upside. We were actually buying last year. Some of that cash on the sidelines actually gives us some hope that this rally could continue, that people will start to re-enter the markets as they feel that things are okay and they're safe. But once again, most investors got this wrong when they should have been leaning into risk instead of being nervous and staying on the sidelines.
So history is right again and repeats again. All right, Colin, we're putting another chart on the screen. Can you talk about some of these recent peaks and valleys? This is the S&P 500. It's kind of the broadest measure of the U.S. stock market. Talk about how people can read the right side of this.
Yeah. So as the chart shows, the markets hit their highs in January of 2022. They retracted 25% to their lows, which was last year, October of 2022. Since then, we've had a little bit of a rally going forward. We're still 7% off those highs, which is quite the rebound going forward. So,
is this a bull market or a bear market rally?
Yeah. So that's the question right now. We've entered where we're at as a new bull market. Some people are still saying this might be another bear market rally, that we might see another low point. If that were to be the case, this would be the longest bear market rally in the US stock market history. So,
all right, another topic to talk through today is where we see opportunity. Josh, talk about the next few months. We just say we don't like forecasting, so we'll keep it kind of short time frame here.
So we said we were excited about bonds. We've been adding to bond allocations, getting even better yields with a couple new funds that we've added to portfolios. On the stock side, we like value stocks in the United States. So those would be kind of boring companies that generate cash flows, maybe are not in the headlines as far as artificial intelligence or driverless cars or cutting edge technology. We think the market's gotten a little bit expensive on some of those themes. So we think if we stay slightly away from some of those, we can get some better valuations. Stocks outside the United States look really intriguing to us, very inexpensive. There's a few tailwinds that are starting to form that make those stocks look attractive to us. And Mr. Warren Buffett's been buying Japanese stocks as well, which is a nice indicator that maybe there's some good opportunity there.
We've talked in our past commentaries on kind of the cyclical rotation of international stocks versus domestic. So we'll put up another chart here for your viewing pleasure. Josh, talk us through purple and gray bars here.
So these mountains, as they look, are illustrating times where the U.S. stock market was leading or stocks outside the United States were leading. You'll see that leadership has kind of changed over time. You'll go through a period where U.S. stocks are doing the best, and then stocks outside the United States will transition and be in a leadership position. We were in the longest time frame in history where the U.S. stock market was really outperforming everything else. You can see we're kind of at the very beginnings of that flipping to international stocks outperforming. So if that is the case, we are well positioned. Our clients have investments outside the United States, which are a great diversifier if the U.S. stock market isn't cooperating.
Okay, Colin, charts are supposed to go up and to the right. This is going down. Tell us why that's a good thing.
yeah, so this shows how expensive the US is compared to the international stock market. This is going down and to the right, showing that the international stock market is very inexpensive compared to the US stock market right now, which, as Josh had mentioned, we have great opportunity sets there to realize some good returns going forward.
All right, Josh, wrap us up with what worries us in portfolios.
There are always things that worry us. So I tell clients our job is to worry about their investments so they don't have to. So like any other time, there's lots of things that we're worried about. One of them is commercial real estate. So as we continue to work from home, a lot of companies try to figure out where their workers are going to be. There's issues with commercial real estate. Office buildings in downtown areas are struggling. We are worried about that because a lot of banks have lent money to those projects. Our exposure for our clients directly to those investments is negligible, but the ripple effects that could happen through the economy, through the banking sector, are something that we think about and worry about. We do like that it's being talked about. It's not a surprise to anybody. This has been in the news for over a year now, so our view is that it's likely not going to be a major catastrophe, but more of a rolling issue that affects a lot of those investors specifically. Something else that concerns us is how concentrated the stock market is in the United States. So a certain amount of companies have been driving a lot of the profits, a lot of the growth in the overall stock market prices. A lot of big tech stocks are in control of the S&P 500 index. We are at peaks as far as how much those top 10 stocks are influencing the overall stock market behavior. That's typically not a good thing. Those 10 stocks usually do not end up being the top 10 stocks 10 years from now. So we have taken steps to underweight some of those really big companies because we feel like it can get pretty risky if the index gets too concentrated.
NASDAQ just went through the large rebalance where they reduced weighting to all those companies. Do you think that has an impact on the markets at all?
Not really.
Did anything move? Was that yesterday?
That was yesterday, nothing moved.
It was like negligible.
There's not enough money tracking the NASDAQ on an index level.
It's all S&P.
Yeah, it'd be S&P or CRISP or those indexes.
Yeah, no.
What are they going to do? Today is July 25th, so the Fed is meeting right now. What do you think is going to happen?
Something that keeps us up at night is that the Fed was really slow to react to inflation going up. They talked about being transitory. They kept rates too low for too long. Our worry is that they're also going to underreact when inflation gets better and the economy starts to cool down. So a lot of the forward indicators show that inflation is cooling. It shows that economic activity is slowing down a little bit, and we hope that the Fed recognizes that. They're meeting today and tomorrow. They're likely to announce another small rate increase here soon, which we think may be the last for a while. And we hope that they let their rate increases permeate through the economy, and that they're patient and look for signs that the economy is slowing and maybe even start cutting rates. But it is something that worries us, that they've been slow to react to data. So the last thing I'll mention that kind of keeps us up at night is, we talked about everybody trying to predict the next recession. It hasn't happened yet, but it's not unlikely or surprising that we could get a recession in the next 6 to 12 months. With interest rates going up, it makes borrowing costs go up. Consumers would have a harder time financing a car, financing a home. So we are expecting some slowdown in the second half of the year. So we feel like we prepared accordingly in portfolios. But like we've talked about, forecasting that with perfection is just not something anybody's able to do. And so we can't predict the future, but we do prepare for it.
As always, if you have questions, contact your primary advisor here at Frazier Financial. There's a lot of activity and research happening in your portfolios. We know that's not always visible on a statement or in your portal, so don't be shy, pick up the phone or shoot us an email, and we look forward to talking soon.